to The Money Manager. In the studio with me in Cape Town is Greg Flash, the Chief Investment Officer of GCI. We're talking about the GCI Global Fund of Funds. I suppose global markets have recovered quite nicely in the last week or two, but August must have been a tough time for you.
Yeah, I think our funds or underlying managers, some of them really got hurt, but we have a diverse selection of them, so I think some got hurt, some didn't. And also, it's such a volatile market. Things move daily.
Yeah.
Depends where they are. They have different effects on them, where they are and what regions, etc.
Yeah, I think without any sort of global event, macroeconomic or geopolitical event, I think it's probably the most volatile period I've ever known in my career in reporting and being in financial services.
Right. Well, definitely for me. I've been around shorter time than you, but yeah, I started in the financial crisis, so that was a very specific period.
One expected.
But this is sort of seems to be ongoing. There's no sort of hint of it ending. There's constant worries around Europe, around the Fed. I mean, the thought that markets can move so much on the Fed. On Janet Yellen uttering a few words.
Not so much Janet Yellen. I mean, we're getting off the point now, but that's my fault, and I'm going to keep going off the point. It's nothing to do with Janet Yellen. It's the reporting of Janet Yellen.
Sure.
Because 20 years ago or 30 years ago, Janet Yellen would have been in a meeting, and it wouldn't have been instantaneous. There wouldn't have been tweets and everything else going on. So that's what contributes to it, and also the computer trading, etc. But I'm being an old bore. In the light of what you've just said, how do you position yourself with the Global Fund of Funds? Tell us about the fund.
Okay, so the Global Fund of Funds has been around for about four or 5 years. It was run on a different strategy before. Stop loss, they would make calls on sectors and regions.
Yes.
We realised that is a very dangerous thing to do. If you're doing fund of funds, you want diversification, and you want diversification of views. So we don't asset allocate, we don't sector allocate. We build a portfolio that is as diverse as possible with managers that have a consistent long-term track record that is there from a skill. You've got to discern if it's from skill or from luck. It's a long enough period and the teams have stayed in place, and you can discern that there's some evidence that there would be a good probability of good performance going forward that meets our criteria. You do that from a quantitative basis and then a qualitative basis.
Yes.
And so that's the standard way. We will screen for funds, and we're looking at a range right across the board. We don't go into very specific areas, so we wouldn't go into Korean equities, as an example, because that's too specific. We rather stick to global mandates. Be they equities, balanced mandates, then regions, so European funds, European balanced, Asia Pacific potentially, US focused. So there is some regional, and then we build up a portfolio using a quantitative optimizer that we have built that optimizes for diversification, for risk return. So it's an efficient frontier type model.
Yes.
And that's all the quant side. You start with that's part of your screening. The more important stuff is afterwards where you go and interrogate the manager, see if the process makes sense, the more qualitative, subjective side.
So you start with the regional and the sectoral stuff, and then you go down to the nitty-gritty. It's almost like saying, I've got this dream, and this dream now has to have goals attached to it, and the goals attached to it is the interrogation period with the fund manager. Yes.
I mean, it's a single manager does exactly the same. They use their data sources. They use Bloomberg. They'll use Deutsche sell-side analysts, or that's more on the quality, but on the screening, they'll use the data services they have. We use a similar thing in a fund-to-fund basis, and thereafter you start looking at analyst views, independent analyst views, as well as our own views, to do that final due diligence.
How fluid a process is this? Because with all the inputs that you've just told me, it must be a daily, and with the volatility you alluded to as well, it must be a daily process.
Yeah, I mean, fund-to-funds people would say that fund-to-fund and multi-management is easier, because you're not trading and there's not much happening.
Yeah.
But actually your calls are larger if you think about it. If you've got a portfolio that has 50 stocks in it, you buy your 2% in them, and you can trade them individually, and you trade them. Even long-term investors who don't trade their portfolio often are still doing some trading. Fund of funds, way we do it, you buy a manager, you've got to stick with them. I mean, you can't buy and sell a manager. It's not a successful way of doing things. Firstly, you won't be able to negotiate decent fees with them that go back to your underlying investors. And it doesn't build stability. It takes a while to get in and out of funds, especially offshore. So making your call and your research it's a big call to bring a new fund in and to sell a fund. So on a daily basis we monitor, but it doesn't mean we change things. But we monitor, we analyze, does the underlying manager, they're being affected by market movements, was that expected? Is that historically happened with their portfolio?
So rather than kick them out, of course, that's sort of you question them and you interrogate them, as you said before. You hinted that there has been a restructuring of the global fund of funds. What form has that taken?
So it has actually, we cleaned out everything we had in there. And the fund, how the fund was also
that's quite a sweeping statement. Why did you do that?
Well, what we did is first we changed the mandate to allow us to, we opened the universe. The fund previously could only invest in FSB approved global funds. And that sits at 400 to 500 funds that are approved by the FSB here. When you've got a universe of 200,000 mutual funds out there that you can fish in, doesn't mean that you're going to buy, you could use all of them.
No, of course.
It opens your universe, it allows more diversification, and so it's more smoother returns.
What's the criteria that the FSB uses to determine those 400 to 500 funds?
Well, it's not really there. It's CISCA. So CISCA 65 says if you want to be unit trust, this is the rules you have to follow. Long only, no hedging, that kind of that's sort of standard long only requirements that the FSB lays down. So they do the same thing for offshore managers. Now, offshore managers would have to, in the past, have to come in here, apply to the FSB, get all that FSB approval. And if you've got a manager, BlackRock, for instance, and they haven't applied, why would they bother with South Africa? They have now. They've come in, but in the past they weren't bothering, and the rules were a little tighter than, for instance, like UCITS compliance. You had a custodian trustee issue that the FSB ruled there that everyone else didn't really worry about, and the rules are a bit. But still, a lot of managers out there are not even aware of South Africa, and if they're more regional stuff, why should we ignore that? So what we said is we'll open our universe, but we have to still apply the same due diligence, actually in more, because we don't have the FSB checking that. And what we did is he said we'll look at UCITS funds, UCITS compliant funds that would be FSB approvable. They'd match, they would be approved if they applied. And that satisfies our trustees. And now we have a much larger universe.
Okay, great. So you cleared everything out. Upset a few people probably, but and just talking about people not knowing about South Africa, when I watched when the SAB Miller AB InBev story started, there was a commentator on an international television station. He said, "Did you know that SAB stands for South African breweries?" So what have you got now? The spring clean has gone, and what have you got?
So we've got a range of funds. When you look at it again, I'm quite amazed at how different they are. We've got Fundsmith Equity, which is a global equity fund, which is quite a defensive type fund. We have a Kames Ethical Cautious Managed, which is a strange one to come in. We didn't choose that, but it floated to the top when we did our DD. They're a balanced equity global manager out there.
That's your top fund holding outside of cash, which is nearly 24%. You've got 16.5% in Kames. What is it? What is Kames?
Kames is a UK-based manager. Sort of two co-managed fund. One of the co-leads is a woman, and that's also an interesting thing from diversification, because there's some research out there that shows that female fund managers and analysts are often more risk aware. So we are different, and we invest and think differently. So it diversifies your managers even more.
Did that make your decision easier or more difficult, or was it just an unintended consequence of Kames floating to the top?
It was unintended. It was completely unintended.
Because I'm just thinking in the future, as financial services burgeons into something even more bloated than it is now, we're going to have the female global fund of funds.
No. We actually happen to have another manager that's also a female lead, and it's not common common here in South Africa, but it does bring an interesting, people see things in different ways, so different backgrounds. So they're an ethical one, so they wouldn't touch tobacco, certain mining stocks, etc. But we don't pick it on that basis. Then there's UK Growth Fund, US Small Companies Fund. We were looking at Asia Pacific Fund that did float to the top. And none of these funds we chose on purpose. The Asia Pacific, we had a call yesterday with them in Hong Kong, and we've said we can't actually invest because they're one of their criteria is their corporate bonds are not always, they play in the junk bond space, and we can't touch that. So that's the extra due diligence that came in afterwards, and it actually stopped us buying that.
Yes.
So it's a wide range. Others.
What's the reason, just going back to the clear out, because this interests me, was the reason for the clear out because the performance just simply wasn't there? Was it because of changing market conditions? Was it because, I don't know, you just didn't seem to gel with the fund managers that you'd chosen?
When I say clear out, we didn't necessarily have to sell all of them because they now became part of the bigger pool of the universe to look at. So there were the names that you'd recognize, South African managers and global managers that are here, that became part of that pool. But when you weight them and you score them against the much larger universe, they didn't float to the top. Right. In the past, there were managers, South African managers, that were floating to the top, but some of them have gone through some difficult times recently. So it wasn't that we said, we don't want any of you guys. It's just rather we said, let's start from scratch as if we were rebuilding it and see what happens. And it happened that none of those ones that we had made it through. So we slowly changed them over. In the short term, and it's a very short, in the last 6 months, which we've been working through this, it has, I mean, the markets are negative. So it's not the greatest time to do this, although it is, because we've seen that our risk numbers have improved versus the category we're in. Various, Sharpe ratios, downside deviations, that kind of, more the technical quantity kind of stuff.
Yes.
As well as drawdowns were lower. And it's a nice footing to, once things turn around, it shows evidence that there would be a good pickup.
There's been a turnaround in the last week or so.
Sure.
Greg, we're going to have to wrap this up now. Just give us your prospects for the fund in 30 seconds.
Yeah, I think we're very excited by this fund because it's a lot more interesting to look at global managers. I think South Africans really need to diversify their investments. This fund happens to focus a lot more on developed markets.
Yes.
And I think South Africans need to have a portion of their money offshore, but they mustn't touch emerging markets. We are an emerging market.
Especially according to the IMF. We'll have to leave it there, but thank you very much for coming in, Greg.
Thank
That's
you.
Greg Flash, the CIO of GCI, talking about the GCI Global Fund.